All right, let's dive right into this explainer and tackle what is, without a doubt, the single most expensive mistake you can make in investing: buying the perfect company at the exact wrong time. You could literally spend hours analyzing balance sheets, find a company with incredible earnings, zero debt, and a massive competitive advantage. But if your timing's off, yeah, you're going to be waiting years just to break even. All that hard work goes right out the window. So this explainer is all about mastering that exact moment of entry.
So tell me if this sounds familiar. Have you ever bought the absolute perfect stock only to watch it instantly plummet 30%? Man, it's brutal, right? It's a shared pain point almost every investor has experienced. You hit buy feeling incredibly confident, and boom, the price slides. It's beyond frustrating. But here's the real secret. The company wasn't wrong, your timing was. And technical analysis, that's our antidote. It completely takes the guesswork out of your entry points and replaces blind hope with actual, readable data.
To fix our timing, we've got to zoom all the way in. We're going to look at the chart not as some boring mathematical graph, but as a literal battlefield. Because every single candle tells a story about the battle between buyers and sellers during a specific time period. It's not random noise, it's human psychology playing out in real time. Here's exactly how to read it. All right, so each candle has 4 specific data points: the open price, the close price, the high, and the low. See that thick part right in the middle? That's the body, and it represents the intense range between the open and the close. It shows you exactly where the opening bell rang and where the dust finally settled at the end of the day. Understanding this anatomy is your very first step to decoding the market's hidden language. And this perfectly illustrates the clash. If it's a green body, the price closed higher than it opened. The buyers won that round. But a red body, the price closed lower, which means the sellers overpowered them and won the day. It's just a brilliant color-coded way to instantly see who's dominating the momentum without staring at a chaotic wall of numbers. Now, what about those thin lines sticking out from the top and bottom? Those are the wicks, or shadows, and they show the full range the price traveled during the battle. So a long upper wick means the price tried to go high, but got violently pushed back down. Conversely, a long lower wick means sellers fiercely tried to push it down, but the buyers stepped right in and fought back. These wicks reveal a massive intraday tug-of-war. Okay, time for a pro tip. Long lower wicks on red days are actually often incredibly bullish signals. It means the buyers are fighting back hard. In fact, if you spot this pattern at the very bottom of a downtrend, it's called a hammer. And you guessed it, that is a classic reversal signal, letting you know that tide is likely turning. Moving on to, from battles to wars, stringing candles together. Because look, winning one daily battle doesn't mean you've won the war, right? Stock prices don't just move randomly. They move in one of 3 distinct trends. First, you've got the uptrend. Higher highs, higher lows. This is the bull's domain, where you want to buy the dips. Then there's the downtrend. Lower highs, lower lows. The bear's domain. Let me be super clear about this. Buying in a downtrend is exactly like trying to catch a falling knife barehanded. You're going to get hurt. And finally, the sideways trend, where price just bounces predictably between a ceiling of resistance and a floor of support. Remember, the trend is always your friend. But listen, no matter what trend or candlestick pattern you see, you absolutely must check the volume. Volume is the actual number of shares being traded, and it's basically the market's ultimate lie detector. Like if a stock breaks out but the volume is super low, yeah, be highly suspicious. It's probably just a fake out by smaller traders. But a breakout on massive, high volume, that means the smart money, the institutional investors, they're stepping in with real conviction. Never ever trust a price move that isn't backed up by solid volume. Next up, we have the macro war, the percent optimism strategy. So, zooming all the way out past the daily candles, we have to gauge the overall market sentiment. Are we swimming in euphoric greed or absolute panic? To figure this out, we use this optimism pendulum, which swings from 0 all the way to 100. 0%, that's maximum fear and pessimism, the absolute rock bottom. 100%, maximum greed and euphoria, where everyone is just recklessly throwing cash at the market. Knowing exactly where we stand on this scale changes absolutely everything about how you manage risk. And this naturally breaks down into the 4 market seasons. Look really closely at winter here. When optimism is down between 0 and 25%, the news is completely catastrophic and blood is in the streets. But here's the crazy secret. This is actually your ultimate shopping season. This is exactly when you want to aggressively buy those sleeping giants. You hold them through spring, and when summer finally rolls around, when optimism blasts above 75% and everyone is getting super greedy, that is when you sell, lock in those sweet profits, and just wait it out through autumn.
It's a cyclical approach that absolutely prevents you from ever buying at the top of a hype cycle.
Which brings us to this legendary quote by Warren Buffett: "Be fearful when others are greedy, and be greedy when others are fearful." It perfectly bridges the gap between reading the charts and executing that percent optimism strategy we just talked about. I know it's super easy to say, but man, it is incredibly hard to actually do because human nature gets in the way. But if you strictly rely on the hard, structural data in the candlestick charts and the optimism percentages, you completely remove emotion from the equation. You logically buy in the winter of fear, and you methodically sell in the summer of greed.
All right, to wrap up this explainer, I want you to look at everything we've covered today. The candlestick battles, the volume lie detector, the macro pendulum of fear and greed. Now, ask yourself this final, absolutely crucial question. Based on all of this data, what season is today's market in right now? Are we basking in a euphoric summer, or are we shivering in a terrifying yet highly lucrative winter? Keep that question in your head every single time you pull up a chart. Happy analyzing.